In the summer of 1861, in a private room above a shipping office overlooking the Liverpool docks, three men sat at a mahogany table and discussed treason. Or profit, depending on your perspective. On one side of the table sat James Bullock, a Confederate naval agent. He had arrived in Liverpool with letters of credit, cotton certificates, and a desperate need for British money to buy warships and weapons for the rebellion against the United States government. On the other side sat representatives of Baring Brothers, one of the most powerful banking houses in London. The men were impeccably dressed, their manner polite and professional. They were not there to discuss politics or morality. They were there to discuss interest rates, collateral, and profit margins. The British government's official position was clear: neutrality. Queen Victoria had declared that Britain would not take sides in the American Civil War. British ships would not transport weapons for either belligerent. British ports would treat Union and Confederate vessels equally. But British capital had no such restrictions. And British capital saw opportunity. The Baring Brothers had been financing global trade for generations. They had funded the Louisiana Purchase. They had bankrolled South American revolutions. They had financed railways across continents. War was not a moral question for them. It was a business opportunity. And the American Civil War represented the most lucrative opportunity in decades. The Confederacy needed everything: ships, rifles, gunpowder, uniforms, and medicine. They had cotton, the most valuable commodity in the world, sitting in warehouses across the South. They were willing to pay high interest rates for loans. They were desperate, which meant they would accept terms that no stable government would ever agree to. It was a banker's dream client. But Baring Brothers wasn't alone in that room, metaphorically speaking. Across London, in the offices of the Rothschilds, Gibbs and Company, and Fraser Trenholm, similar conversations were taking place. Confederate agents were shopping for credit, and British banks were competing to provide it. The calculus was simple. If the Confederacy won, the bonds would be repaid with interest, and British banks would have privileged access to Southern cotton for generations. If the Confederacy lost, well, that's what collateral was for. The cotton certificates could be redeemed regardless of who controlled the South after the war. But here's what the Confederate agents in Liverpool didn't know, what they couldn't have known. Some of those same British banks were simultaneously financing the Union. Baring Brothers had departments that didn't talk to each other. Partners who maintained plausible deniability. A loan desk in London that dealt with Union purchasing agents. A merchant banking division in Liverpool that handled Confederate cotton bonds. The right hand wasn't just ignorant of what the left hand was doing, it was deliberately blind. This wasn't about picking sides. This was about ensuring that regardless of who won the American Civil War, British banks would profit from it. They would lend to both armies, finance both navies, and collect interest from whoever survived. It was amoral, cynical, and brilliantly profitable. And it was about to become the standard operating procedure for international finance for the next century and a half. The financial war behind the Civil War was beginning. And in that war, there would be only one winner: the banks. The Confederate bonds being sold in London and Liverpool in 1862 were not abstract financial instruments. They were claims on cotton. Actual, physical cotton sitting in warehouses across the South. And to the British banking houses financing them, cotton was as good as gold. Better than gold, actually, because you could turn it into cloth and sell it for profit. The Baring Brothers and the Rothschilds understood this intimately. They had spent decades financing the cotton trade. They knew the mills of Lancashire. They knew the merchants of Liverpool. They knew that the British textile industry consumed 75% of its cotton from the American South. Before the war, the system had worked beautifully. Southern planters grew cotton. Liverpool merchants shipped it to England. British mills turned it into textiles. Banks like Barings financed every step of the transaction, taking a cut at each stage. It was a circular flow of capital that generated enormous wealth for everyone involved. The Civil War threatened to destroy that system entirely, and the British banks that had profited from it had every incentive to ensure the South survived. This is why the Confederate cotton bonds found such eager buyers in London. When Emil Erlanger issued those bonds in March 1863, the biggest purchasers weren't random speculators. They were Liverpool cotton merchants and the banks that had always financed the cotton trade. These men weren't betting on Confederate military victory. They were betting on preserving their cotton supply chain. They needed the South to survive as an independent nation because an independent South would continue the cotton trade exactly as it had existed before the war. A South reintegrated into the United States might diversify its economy, might develop industry, and might become less dependent on cotton exports. The banks couldn't allow that. Their entire business model depended on Southern cotton. The Rothschilds, typically more cautious than Barings, also saw the opportunity. They didn't buy Confederate bonds directly. That would have been too politically risky. Instead, they provided credit lines to merchants who bought the bonds. They financed the purchase of Confederate cotton that was run through the blockade. They ensured that even if the Confederacy fell, the cotton would still flow to Liverpool. The scale of British financial investment in the Confederacy was staggering. By 1863, British banks and merchants had extended over £20 million in credit to Confederate agents and cotton traders. In modern terms, that's over $2 billion. It was one of the largest concentrations of foreign capital in a rebellion in history. And it created a powerful political constituency in Britain that desperately wanted the South to win. The Liverpool merchants, whose fortunes were tied up in Confederate cotton bonds, began lobbying the British government for recognition of the Confederacy. The banks that held those bonds used their influence with Parliament to push for intervention. This is why the Confederate strategy of cotton diplomacy wasn't entirely insane. It failed to account for British stockpiles and alternative sources. But it correctly identified that British financial interests were aligned with Southern independence. The problem was that those same British financial interests were hedging their bets. While Barings' Liverpool office was financing Confederate cotton, their London office was quietly doing business with Union agents. The British banks had learned the cardinal rule of war profiteering. Never put all your money on one side. Finance both armies. That way, you win regardless of who loses. While Confederate agent James Bullock was meeting with Baring Brothers representatives in Liverpool, something remarkable was happening 300 miles away in London. In the headquarters of Baring Brothers on Bishopsgate, in a different set of offices, Union purchasing agents were negotiating their own loans, the same bank. The same week, financing both sides of the same war. The mechanism that made this possible was brilliant in its cynicism. It was called departmentalization, though a more honest term would be willful blindness. Baring Brothers operated multiple divisions that functioned with deliberate independence. The merchant banking division in Liverpool handled cotton trade and Southern bonds. The government securities division in London dealt with Union Treasury agents. The partners maintained plausible deniability. If confronted about Confederate financing, the London partners could truthfully say they had no direct involvement. If questioned about Union loans, the Liverpool office could claim ignorance. The organizational structure created a buffer where morally questionable decisions could be blamed on subordinates or separate divisions. It wasn't illegal. Britain was neutral. British banks were permitted to lend to anyone. But it was deeply duplicitous, and the banks knew it. Internal correspondence that survived shows partners carefully avoiding putting certain transactions in writing, using intermediaries for sensitive deals, and structuring loans to obscure the ultimate beneficiary. The Union loans were more straightforward than Confederate financing. The United States government, despite the rebellion, still controlled the industrial North, the major ports, and most of the nation's gold reserves. Union bonds were safer investments. They paid lower interest rates than Confederate securities, but they were far more likely to be repaid. Barings wasn't the only British bank playing both sides. The Rothschilds famously refused to buy Confederate bonds publicly, maintaining their reputation for backing stable governments. But they provided credit facilities to firms that did buy Confederate bonds. They financed Union war supplies while simultaneously profiting from the Confederate cotton trade through third-party arrangements. Smaller banks like Gibbs and Company and Brown, Shipley and Co. were less cautious. They openly dealt with both Union and Confederate agents, sometimes in the same building on the same day. The financial district of London became a bizarre neutral zone where enemies negotiated loans side by side. The cold calculation behind this strategy was simple. Wars end, but debts remain. Whichever side won would control the wealth of the entire United States. British banks wanted to be creditors to whoever emerged victorious. By lending to both, they guaranteed they would be owed money by the winner. It was hedging taken to its logical extreme. And it was extraordinarily profitable. The banks collected interest from the Union. They collected fees and commissions from Confederate bond sales. They financed cotton exports from the South and war material exports to the North. Every ship that sailed, every bond that was sold, and every loan that was extended generated revenue for British banks. The partners of these banking houses would later claim they were simply businessmen staying neutral in a foreign conflict. But the truth was darker. They were profiting from both sides of a war that would kill over 600,000 Americans. They were financing the rifles that would shoot Union soldiers and the cannons that would bombard Confederate positions. And they were doing it with the full knowledge that one side's debt would eventually be repudiated, meaning they were selling financial products they knew would become worthless. They just didn't know which side would default. That uncertainty didn't stop them. It just made them charge higher interest rates. By 1862, the Union government knew British banks were financing the Confederacy. What they couldn't prove was how. The transaction trails were deliberately obscured, routed through a labyrinth of intermediaries designed to provide plausible deniability and avoid American retaliation. The system worked like this. Confederate agents didn't deal directly with London banks. They worked through intermediaries in Nassau, Bermuda, and Havana. These neutral ports became financial laundromats where Southern cotton and gold were converted into British pounds and European credit. Fraser, Trenholm and Company was the masterpiece of this system. It was technically a Charleston firm with offices in Liverpool, but in reality, it was a British-Confederate joint venture designed specifically to circumvent neutrality laws. The company would purchase cotton in the South using Confederate currency, ship it through the blockade to Nassau, then sell it in Liverpool for British pounds. Those pounds would then finance purchases of weapons and ships for the Confederacy. On paper, Fraser Trenholm was just a cotton merchant. In reality, it was the Confederacy's de facto Treasury Department in Europe. British banks would lend to Fraser Trenholm, not to the Confederate government. This distinction was legally crucial. Britain's neutrality laws prohibited lending directly to a belligerent government, but there was no law against lending to a private trading company that happened to do business with the South. The shell company structure provided cover for even more elaborate schemes. Baring Brothers might extend credit to a Liverpool merchant firm, which would purchase cotton certificates from a Bermuda trading house, which had acquired them from a Nassau intermediary, which had bought them from Fraser Trenholm. By the time the transaction was complete, there were 5 layers of separation between Baring Brothers and the Confederate Treasury. Confederate gold followed similarly complex routes. Rather than shipping gold bars directly to London, which would have been obvious and potentially interceptable, Confederate agents deposited gold in banks in Havana and Nassau. Those banks would issue letters of credit that could be redeemed in London. The gold never left the Caribbean, but Confederate agents in Britain had access to funds as if it had. The British banks facilitated all of this. They maintained correspondent relationships with banks in neutral ports specifically to handle these transactions. They created specialized departments that understood blockade running schedules, cotton prices in different markets, and the legal technicalities of neutral trade. The system was so elaborate that even when Union agents in London discovered Confederate financing, they struggled to build legal cases. Every transaction had been structured to technically comply with British neutrality law. The banks could point to paperwork showing they had lent to private merchants, not governments. That those merchants were Confederate agents was circumstantial. It was financial engineering at its most cynical and sophisticated. British banks had created a system that allowed them to profit from financing a rebellion while maintaining legal deniability. They were violating the spirit of neutrality while adhering to its letter, and they would have gotten away with it completely if the Union had started building a file on every ship, every loan, and every transaction. A file that would become the basis for the largest international arbitration claim in the 19th century. The British banks thought they were being clever. They didn't realize they were creating evidence. In the summer of 1863, Secretary of State William Seward sat in his Washington office reading intelligence reports from Union agents in Britain, and his anger was cold and methodical. The reports documented something that went far beyond British sympathy for the South. They documented active financial conspiracy. British banks weren't just passively neutral. They were financing Confederate warships, ships that were hunting American merchant vessels. Ships that were destroying Union commerce and killing American sailors. The most infamous was the CS's Alabama. Built in the Laird shipyards in Liverpool, financed through a complex arrangement involving Fraser Trenholm and backed by credit from British banks, the Alabama was a commerce raider that would sink 65 Union merchant ships before it was finally destroyed in 1864. Each of those ships represented American lives and American property destroyed with British money. Lincoln's administration began building a case. Union agents in London compiled lists. Every ship built in British yards for the Confederacy, every loan extended to Confederate agents, and every transaction that had passed through British banks. The documentation was meticulous. Names, dates, amounts, intermediaries. The legal theory was straightforward. Britain had declared neutrality, but British financial institutions had violated that neutrality by providing material support to the Confederacy. Under international law, a neutral nation is responsible for the actions of its citizens that violate neutrality. Therefore, Britain owed damages. The amounts being calculated were staggering. Union lawyers estimated that Confederate raiders built and financed in Britain had destroyed over $15 million in Union shipping. But the indirect damages were far larger. Insurance rates for American ships had skyrocketed. American merchants had been driven from international trade. The American merchant marine, which had been the second largest in the world, had been decimated. Seward's initial damage claim was $2 billion. $2 billion. It was more than the entire British government budget. It was an astronomical sum designed to make a point. British neutrality had been a fiction, and there would be consequences. The British government was blindsided. They had assumed their neutrality declarations provided legal cover. They hadn't realized that American agents had been documenting every transaction, every ship, and every loan. The evidence was overwhelming and undeniable. Worse, the British banks that had profited from Confederate financing were now backing away from responsibility. Baring Brothers claimed they had only lent to private merchants, not the Confederate government. The Lairds claimed they had built ships for private buyers who happened to be Confederate agents. Everyone had plausible deniability. Everyone was technically legal. But the Union wasn't interested in technicalities. They were interested in justice or revenge. The distinction was unclear. By 1865, with the Union victorious and the Confederacy destroyed, the diplomatic situation was dire. The United States was the most powerful military nation on Earth, with a battle-hardened army of over 1 million men and the world's most advanced navy. Britain was isolated diplomatically, facing a furious United States that had evidence of British financial support for a failed rebellion. The Alabama claims, as they became known, represented an existential diplomatic crisis. If not resolved, they could lead to war between Britain and the United States. A war that Britain, despite its empire, might very well lose. The banks that had profited from both sides were about to discover that when one side wins decisively, neutrality becomes a liability. When Lee surrendered at Appomattox in April 1865, the celebration in London's financial district was muted. The war was over, but the reckoning was just beginning. Confederate bonds, which British banks and investors held by the millions, were instantly worthless. The Confederate government no longer existed. Its debts died with it. The cotton certificates that were supposed to back those bonds were now claims on cotton controlled by the victorious United States government, which had no intention of honoring Confederate obligations. Baring Brothers alone held over £3 million in Confederate securities. The Rothschilds had exposure through intermediaries. Liverpool merchants, who had bet everything on Southern cotton bonds, watched their fortunes evaporate overnight. By some estimates, British investors lost over £20 million on Confederate debt. In modern terms, that's over $2 billion simply gone. But the financial losses were just the beginning. The Union hadn't forgotten who had financed the rebellion, and they wanted payment. Secretary of State Seward formalized the Alabama claims in 1865. The initial demand was $2 billion in damages for British violation of neutrality. The claim detailed every Confederate ship built in Britain, every loan extended by British banks, and every transaction that had supported the rebellion. It was a legal brief and an indictment. The British government was caught in an impossible position. They couldn't simply pay $2 billion that would bankrupt the empire. But they couldn't deny the claims entirely because the evidence was overwhelming. British banks had financed Confederate warships. British shipyards had built them. British ports had harbored them. The banks that had profited now began a desperate lobbying campaign. Baring Brothers, facing potential government seizure of their American assets, pushed the Foreign Office to settle quickly. The Rothschilds, with extensive American business interests, pressured Parliament to make the problem go away before it escalated to trade sanctions or worse. The bankers' argument was self-serving but effective. British businesses had lost millions on Confederate bonds. They had already paid a price for their miscalculation. Further punishment through government reparations would be excessive. And if Britain didn't settle, American anger might lead to confiscation of all British assets in the United States. That final threat concentrated minds wonderfully. British banks held hundreds of millions in American investments, railroads, mines, and factories. If the United States seized those assets as compensation for the Alabama claims, the financial damage would dwarf any negotiated settlement. The diplomatic correspondence between London and Washington became increasingly tense. The United States had a million-man army and was in no mood for excuses. Britain had the empire, but was diplomatically isolated. France was neutral. Russia, still bitter over British support for Turkey in the Crimean War, was quietly encouraging American demands. By 1870, it was clear that Britain would have to settle. The only question was the amount and the mechanism. The British government couldn't be seen as simply capitulating to American demands. They needed international arbitration, a face-saving process that would produce a settlement both sides could accept. But behind closed doors, British banks were already calculating. Whatever the settlement amount, it would be far less than $2 billion. And it would be paid by the British government, not the banks that had actually financed the Confederacy. The banks had privatized the profits and were about to socialize the losses. It was the perfect crime almost. Except the precedent it set would haunt international finance for the next century. In September 1872, an international tribunal convened in Geneva, Switzerland, to resolve the Alabama claims. It was one of the first major international arbitrations in history, and it would establish principles that would govern neutral conduct in war for the next century. The tribunal consisted of representatives from the United States, Britain, Italy, Switzerland, and Brazil. The American case was presented methodically. Here are the ships built in Britain, here are the Union vessels they destroyed, and here are the damages. The evidence was overwhelming and undeniable. The British defense was technical. They argued that private citizens and companies had acted independently. The government itself had maintained neutrality. They could not be held responsible for the actions of bankers and shipbuilders who had technically violated no British laws. The Americans countered with a devastating argument: neutrality is not passive. A neutral government has an obligation to prevent its territory and its financial system from being used to support belligerents. Britain had failed that obligation. British banks had financed Confederate warships. British ports had allowed those ships to operate freely. The government's failure to stop it made them complicit. The tribunal deliberated for months. When the decision came in September 1872, it was a diplomatic disaster for Britain. The tribunal ruled that Britain had violated its duties as a neutral nation. Britain was liable for damages. The award was $15.5 million in gold. It was a fraction of the $2 billion the United States had originally demanded, but it was still an enormous sum. In modern purchasing power, it's equivalent to over $300 million. Britain was required to pay it immediately in gold to the United States Treasury. The British government paid. They had no choice. To refuse would have meant war or complete diplomatic isolation. The gold was transferred in 1873, and the Alabama claims were officially resolved. But the real cost was borne by the British banks that had financed both sides. Their Confederate investments were total losses. 20 million pounds vanished. Their reputations were damaged. And they had created a legal precedent that would limit their future war profiteering. The Geneva Settlement established that neutral countries could be held liable for allowing their financial systems to support belligerents. It meant that in future wars, banks in neutral countries would have to be more careful, more discreet, and more creative in how they financed both sides. It didn't stop them. It just made them better at hiding it. The Baring brothers survived the losses. So did the Rothschilds. The smaller banks that had been more reckless, some failed. But the big institutions weathered the storm because they had hedged. Their Union investments had paid off, offsetting their Confederate losses. When the books were finally balanced, most British banks had broken even or made modest profits from the Civil War. They had financed both armies, lost money on one and made it back on the other. It was exactly what they had planned. The Geneva Settlement didn't punish the banks. It punished the British taxpayer, who had to cover the $15.5 million payment. The banks that had privatized the profits from war financing successfully socialized the losses when the bill came due. It was a masterclass in systemic risk and moral hazard. The banks had taken enormous gambles, knowing that if things went wrong, the government would ultimately bear the cost. And they had been proven right. The precedent was set. Not just the legal precedent about neutral liability, but the financial precedent. Banks could profit from war with minimal personal risk. The British banks that financed both sides of the American Civil War didn't invent war profiteering. But they did invent something more insidious, the systematic, institutionalized practice of financing all sides of every conflict to guarantee profit regardless of outcome. It was a business model. And it worked so well that it became the standard operating procedure for international finance for the next century and a half. When World War I erupted in 1914, the same banks, Barings, Rothschilds, and their successors followed the exact playbook. Before the United States entered the war, J.P. Morgan's London office financed British and French war bonds while maintaining relationships with German industrial firms through neutral intermediaries. American banks lent to the Allies while their European branches maintained credit lines with Central Powers companies. The complexity increased, the intermediaries multiplied, but the principle remained: never put all your capital on one side of a war. World War II saw even more sophisticated arrangements. Swiss banks famously held Nazi gold while simultaneously managing Allied assets. American banks did business with German subsidiaries until Pearl Harbor, then seamlessly pivoted to full Allied support. The corporate structures, the shell companies, and the neutral jurisdictions were all perfected techniques first developed during the American Civil War. The Cold War turned it into an art form. Western banks financed both NATO and Soviet bloc countries through layers of intermediaries. They lent to anti-communist governments while their subsidiaries provided credit to state-owned enterprises in communist nations. Every arms race, every proxy war, and every conflict was an opportunity for banks on both sides to profit. Even today, the pattern continues. International banks maintain relationships with all sides in regional conflicts. They finance governments and rebel groups, often simultaneously, through complex corporate structures designed to provide plausible deniability. The techniques pioneered in 1861 Liverpool are now global and digital, but the principle is unchanged. Because the lesson the British banks learned from the Civil War was simple and brutal: capital has no loyalty. Capital has no ideology. Capital has no patriotism. Capital has only one allegiance to returns. The banks that bet on the Confederacy lost money. The banks that bet on the Union made money. But the banks that bet on both broke even or profited regardless. And that lesson that hedging is always superior to choosing sides became the foundation of modern international finance. The Geneva Settlement didn't change this. It just made banks more careful about documentation. The $15.5 million payment didn't deter future war financing. It just taught banks to use better intermediaries and more complex corporate structures. Because ultimately, the settlement proved that even when caught, even when their duplicity was exposed, even when an international tribunal ruled against them, the banks didn't actually pay the price. The British taxpayers did. That's the real legacy of British banks financing both sides of the Civil War. They established that financial institutions could profit from war with minimal personal risk. They could finance armies that killed each other, collect interest from both sides, and when the reckoning came, pass the cost to governments and taxpayers. It's a system that has persisted for over 150 years because it works. Wars are profitable, and if you finance both sides, you're guaranteed to be owed money by whoever wins. The 600,000 Americans who died in the Civil War became line items in British banking ledgers. Their deaths generated interest payments, bond commissions, and currency exchange fees that flowed to London counting houses. I'm Mark, and this is the Economic Warfare Tales channel. Subscribe now because the next time you hear about banks financing infrastructure projects in conflict zones or providing credit lines to governments on opposing sides of a dispute, you'll recognize it. It's not modern complexity. It's not innovative finance. It is the same playbook written in a Liverpool office in 1861. The only thing that has changed is the scale. Capital still has no loyalty, it only has returns. And it will finance anyone willing to pay the interest rate.